Donald Trump has come, and he has come with a very extreme stance this time. You saw all mid and small caps being hit. Markets are still highly volatile. So FII still don't think that India is fairly priced and they are going more towards China. The market has gone through a period of extreme volatility. We've seen valuations correct in small caps on an average of 20 to 30%, and even large caps have seen a lot of correction. And there's a lot of reasons to think about for this drawdown. You can see that Indian valuations were at an extreme. We were trading at a very high P ratio compared to the emerging markets, and as the earning growth has slowed down, as the GDP growth has slowed down, the attractiveness of our stock market has reduced, which has led to some selling by FIIs. But that is not the only reason. If you look at the markets right now, with the amount of correction that we have seen, many of the high growth stocks have reached their PEG ratios, PE to growth ratios, which is less than 1 in fact, which makes them a decent buy on the valuation levels. But there is another big element at play in this scenario. Donald Trump has come, and he has come with a very extreme stance this time. He doesn't seem to care about the recessionary environment in the US. He doesn't care about the stock market volatility, and he's taking extreme steps to sort of increase tariffs across the world, cut down on government spending, and that is going to have a second order effect on the markets. So while the Indian market might have gone through the correction in terms of valuations and we might be fairly priced, but we are still not accounting for the impact of the US policies. So in this video, we'll talk more about this correction. We'll talk more about what's happening out there in the US and how do the tariff wars impact India. So a lot of our clients will come and ask us that why did you not handle this drawdown well? We've seen a drawdown and it's been more than some indices, some other funds, but it has been in line with strategies that have been taking risk, right? There are two types of errors that you can make in the market. One is sort of taking risk and going wrong, and second is not taking risk and sort of getting a lost opportunity. So in this period, made the first type of error where we took risk and got hit. We were aware that there's a change that is happening in the market, and what we had done in our strategies is pivot towards defensive stocks, pivot to segments where we saw lesser risk, more linked to domestic growth, more linked to sectors in the economy that would grow strong. But then when the panic selling happened, you saw all mid and small caps being hit. And while we have seen some recovery over the past week, that doesn't seem to stick. We see that the markets are still highly volatile, and that is because there's a lot that is changing around the world. In the 5.5 years of Wright research, we've seen a few drawdowns. We started just before COVID, so we saw the COVID crash. And then we've seen a lot of volatility in 2022, and 15%, 20% drawdowns in a high risk strategy, they tend to happen once in a while. But this time it could be different, right? Because the valuations were at a peak. We've seen a very secular sort of a bull market for 2 years. Our valuations were at a very high level and actually much higher than our emerging market peers. So we did see a valuation correction, but now the global impact is going to come and play a role. In fact, if you look at the earnings of India, you will see that now our EPS growth rate is sort of at par with many of the other emerging markets, but our small and mid caps still trade at a higher premium compared to the emerging markets, which is slightly concerning, because if you look at China, that is trading at a much lower level. So FII still don't think that India is fairly priced and they are going more towards China. And when does a recovery happen? A recovery happens when one of the two things would happen. Number one, we start seeing an uptick in earnings. We start seeing our EPS growth rates grow up across the companies. We see sales growth rates go up, but that might not happen with a very drastic fashion in the next quarter. We might see some upticks because there has been some positive macro data, but we don't expect a drastic recovery over there. Second thing that could boost our markets is stimulus by the government, or some fast-paced rate cuts. Once that happens, that leads to recovery in the economy. So those will be the two cues to watch, and I think before that we could see a lot of speculation and volatility, especially in the small and mid caps. So we track a number of strategies that we think are key in our portfolios. Obviously one of them is momentum, but along with that, we track quality plus momentum and valuations and quality plus momentum. And we see that right now focusing on quality, low risk and good earning momentum could be the key. And that is what we think would be important in this volatile time. In our momentum strategies, we'll see a pivot towards defensive stocks, a pivot towards large cap stocks, and that would be sort of protecting them. In our PMS strategies, in fact, we took our decisions to hedge our portfolios towards the beginning of March, and that has been, keeping the portfolio very, very steady. We see that, we are not biased by any sorts of recovery right now, because we think that there will be volatility and it is a safe thing to stay away from high beta portfolios right now and sort of focus on stocks where you have quality and a moat present in terms of cash flows, in terms of consistency of ROE, and that would be the area that you could focus on for some time. So that was a bit about our portfolios and about the broader economy. We are out of the India-centric correction, I think, right? We saw a correction only in India. If you compare Indian markets with emerging markets or Indian markets with global markets, over the past 5-6 months, only India has corrected, right? And that is because FIIs have pulled out money out of India. They think that the market got a little bit overvalued, and I think that correction right now is over. But now we have another worry. This is the global macro scenario, or what's happening with the tariffs. So let's try to understand how these tariffs will come and impact the Indian market. The Trump administration seems to be very, very aggressive with their tariffs this time. At the outset, they started with big tariffs on Canada and Mexico and on China. And while they have rolled back and come back with those tariffs again and again, things have escalated where Canada is still holding some of those tariffs, and a lot is changing in the global trade. China is very aggressive and they want to fight this trade war with the US, and this is going to have implication across the board. If you look at the relationship between India and the US in terms of tariffs, you would see that India charges a higher tariff on US exports. The US tariffs had sort of remained steady, going from 3% to 4% from 2018 to 2022, but Indian tariffs against US have actually increased. So right now, the average tariff by the US on India is close to 4%, whereas India charges close to 16% tariffs on US exports. So India has actually used tariffs as a tool to boost domestic growth and sort of tax foreign exporters, whereas US has been sort of lenient on that front. And I think we all know that is going to change with Donald Trump coming up, right? Donald Trump is going to match tariffs, is going to put reciprocal tariffs across different countries. And as the tariffs on Indian exports increase, that would have an impact on different industries. Right now, 57% of Indian exports actually go to the US. And the key industries that are impacted are diamonds, petrochemicals, semiconductors, and electronic components. And those will be the industries where you could see either, escalation of tariffs, or, India reduces their tariffs to match up with the US market. So with the reciprocal tariffs, if you actually look at it, India is one of the highest tariff countries across the board. And on an average, the tariffs in India could increase by 7%, right, by the US, and that could have impact across the industry. So there are two things that could happen. One is a uniform tariff. If a uniform tariff like they put on Canada and Mexico, that happens, you could see a 7% increase across the board. Or there could be another scenario where they do sector or product specific tariffs, where on any product where India has a higher tariff, they could also increase tariffs. That would require some research and revision on different products, and that could have a different sort of an impact. If the US targets specific Indian products, then that could also have a far-reaching impact. Our top exports like marine and diamonds and petrochemicals already face high tariffs, and if those are increased, Indian products could in fact become less attractive in the global markets. Donald Trump has actually pointed out at India that we have very high tariffs, and he's going to put a reciprocal tariff on us. So there you have agricultural products where we have 40% tariffs, or automobile components where you even have 100% tariffs that India charges. If a reciprocal tariff is hit, that could impact the industries as a whole. So what will be the sectors that will be impacted by this tariff war? First one would be the auto components. On the auto component side, India has much higher tariffs compared to the US. And if the reciprocal tariffs are put, that will impact the auto component industry. Indian exports to the US account to 2 billions in auto components, and that would be impacted if such tariffs are put in. Second sector where you could see an impact is pharmaceuticals. India is a big pharmaceutical exporters, amounting to 47% generic prescription export to the US and 15% in biosimilars. So if that segment is hit, you could have far-reaching impact. But Indian pharma products are much cheaper compared to the US, and they have helped the US economy actually save a lot of money in this trade relationship. So we will see how that implication changes. Another segment that could be hit is India's nascent semiconductor industry. While India is not a very big semiconductor player, but in all the semiconductor that India manufactures, 90% of those exports actually go to the US. So if that tariff is impacted, the nascent growth of our semiconductor industry could also be impacted. The diamond market, which is already struggling, could again face tariffs more than 10% and could see more pain. And agriculture and money goods could also see some impact because India has 38% on agricultural goods, whereas US only has 8% tariffs. If reciprocal tariffs are impacted, Indian exports of agriculture products could also be impacted. Similarly, while India is not the biggest smartphone manufacturer, the smartphone industry could also be hit because of these tariffs. And similar to diamond, jewelry industry could also see higher tariffs and could see some impact. So what is the Indian government doing right now? We can already see that the tariffs across the board, from certain auto components to some food products, you can see tariffs have been reduced. The tariffs on luxury cars and alcohol products have already reduced in India. And we could see Indian government sort of adjusting their tariff regime to find favorable trade terms. On the other hand, another thing that the US government is going to look at is the Indian tax regime. So the GST and the VAT that India implements, they also form the part of the tariff calculation that the US looks at. And India has some high GST and VAT numbers. So that regime could also be looked at, and we have seen the finance minister actually come out and say that they're going to rationalize and reduce some of the GST tax rates. So that could also be maybe a positive implication of this tariff war. Now, what could be the broader implication of this high tariff regime in the US and the world? See, in the US, there is a big recessionary fear that is coming. Atlanta Fed has actually come out and said that the growth rates are actually going to go negative in the US due to the implication of these tariffs. So a globally recessionary environment could definitely have an impact on India. And secondly, if not recession, it would have other smaller implications on the economy. So if you look at 2018-19, you will see a few things that happened in the market. Number one is inflation. 2018-19 led to higher inflation across the board because due to these tariff wars, goods and services became expensive. And as goods and services become expensive, what you would see is that the consumer demand, the demand for different products would also decline. And that could have an implication in the recessionary environment. As different industries and sectors are impacted by this, you would see manufacturing and services sector also see an impact. If you look at different sectors, you would assume that because of tariff rates being put on the metals, aluminium and all those segments, you would see a price decrease, but actually the production price of these components increased. And as the production price of these metal components has sort of increased, that passes on to the consumer products and you see higher inflation led by the producer price index. So last time what you saw was furniture and large appliances saw a hike in price, whereas electronic and sporting goods also saw a price hike, but then they reduced after some while. So obviously who would gain from or who would be stable in this price war would be sectors and industries where you have pricing power, right? Companies with a strong hold on the market, with strong balance sheets, strong growth rates, they will be able to negotiate better on the prices with the consumers, right? So therefore high quality and larger stocks will be better positioned to deal with this volatility. Similarly, companies which are much more nimble and robust, which can adapt their supply chains, right, which are not tied up in projects which cannot move, they will be more nimble and they will adapt to this changing scenario. And those will be the companies that will stand out strong. The World Bank sort of projects that GDP growth rate across the world would slow down and inflation could increase. But even despite all this volatility, India does remain a bright spot, right? Indian growth rate is in fact the highest among the emerging markets, and our valuations have actually corrected down, right? So we are fairly priced if the Donald Trump policies had not come in. And while China looks attractive right now, people expect long-term growth rate of China to actually go down, and India's growth rate is expected to increase further. So India would remain an attractive long-term buy, and we would see FIIs come back in once the rationalization of this tariff policy is done. And we've seen rationalization on the valuations as well. Last time when Donald Trump put out those policies in 2018, what we saw was developed markets outperformed the emerging markets, and in emerging markets you saw larger stocks do better than small and mid caps. So that could be one bias that you could in fact build into your portfolios. Looking at maybe the global markets right now, I think China is an attractive spot, even though the US market is going through very, very sharp corrections right now. So having some global diversification could also be interesting at this point in time. So when will this market find its bottom? I think the one big thing to watch out would be the earning trends. You can see that India was a bright spot globally because Indian management companies are very strong. And what you've seen is while growth rates across the board slowed down, Indian companies increased their margins, right? And they did have strong earning growth despite sales growth slowing down. What we are seeing right now is even the earning growth has also slowed down, same as the sales growth, and that could be sort of the bottom. In the upcoming months, when this situation stabilizes, we could see an uptick in the sales growth as well, and that would be when the markets find their bottom and see a good uptick. Another big thing that could boost the market would be rate cuts, but rate cuts that come on time. Typically, central banks tend to delay rate cuts till they see significant growth slow down. But in this scenario, if we have rate cuts come at the right time, many are speculating in April we could see a good rate cut. If that happens, that could give a good boost to the markets. So what is the outlook for the earnings season that is coming, and will we see that uptick? There's a lot of positive news that is floating around in the market right now. The government is spending some money on capex, and that will give a boost to the manufacturing and capital goods segment. Right now, agriculture as a theme is looking strong. The monsoons were good, and there is going to be a higher agriculture growth, so that could see a positive in the upcoming earnings season. Manufacturing could see an uptick, but we would see an impact of the tariffs there. You could see segments like banking and financial do well, and they actually did well in the past quarter as well. We are seeing big impact on the asset management industry, the capital market industry, and that would be a shocker. You would see metals, autos, and cement to actually have an uptick in the next quarter. So the mix of sectors that we were talking about a few months ago seems to have again changed, right? Consumer does remain strong, consumption demand would be there, but we might not see that much attractiveness in the real estate segment. On the other hand, you could see manufacturing, infrastructure, capital goods, banking, financials, autos, metals, cement, which were not in favor, get some uptick. What we really hope is that last quarter was the bottom of earning decline. We've seen our EPS growth really come down, match the sales growth rate, and we expect some uptick to happen at the bottom from here. So a good uptick in earnings and a rate cut that is coming could provide an uptick to Indian equities. But on the other hand, we have to watch out for the global scenarios. Obviously, the tariffs will impact India, and we've explained that a little bit. But a global recession, if that happens in the US, or a US recession, if that happens, that could also have an impact on India. The geopolitical scenario with what's happening in Ukraine is escalating, and that obviously would have impact across the world. So a very interesting time in the market. What makes sense right now is to deploy your capital diligently, be focused on companies that have pricing power, that have strong moats, and who can survive this correction. And also maybe look at some global diversification, protecting your capital by hedging or buying some gold. And I think the market will give us clear signals when it's an uptick, and we hope that time is not that far away. So that was our quick video on what happened in the market, about this correction, about how the tariff wars will impact the market. I hope you found it useful and this will help you sort of navigate this volatile time a little bit better. If you like this video, please do hit the like button, put down in the comments what you liked about it and share it across with your friends. Please subscribe to our channel and we'll see you again next time. Till then, happy and safe investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.